For most of you, you're taking out the minimum amount from your RRIF, your retirement income fund. But the reality is that could be a huge mistake, costing you tens to even hundreds of thousands of dollars through retirement and at death. So in this video, I want to share our software and break down why taking the minimum amount probably doesn't make the most sense, as well as some strategies that you can use moving forward to make sure that you pay the least amount to CRA, put the most amount of money back in your pocket. I'm going to break down two different examples, 3 scenarios for each one, and I want to break it down to show you the little impact that can have, but how it compounds over time, and little decisions and little tweaks in your retirement plan can have a massive difference down the road. So make sure you pay attention here on how this works and the general theme of it. And it doesn't matter what age you are. You could be early in retirement or later in retirement. And these small tweaks can have a massive difference. Obviously, the more money you have, the bigger cash savings. But again, if you have less money, you're probably living on less income. So every small change will help, even if it's hundreds, even into the thousands of dollars of savings. So let's jump into the first example here, which is a 72-year-old man. He retired, single, has $300,000 in his RRSP and $75,000 in a TFSA account. Now, this is how Mr. YouTube has been living his retirement, and he hasn't made any adjustments to this. He's taking out the minimum RRIF amount, which is such a large majority of the Canadian population. It's just they convert the RRIF, they take the minimum amount and supplement it with whatever other assets they have. In this case, he's collecting CPP, old age security, and he's pulling the minimum amount for him, which is $15,840 from his RRIF account. Now, the other income that he's drawing to hit his required income, which is $42,000 for the year, is from the TFSA. So he's taking CPP, old age security, his minimum RRIF, and whatever else he needs to get to his $42,000, he's pulling from his TFSA account. Now, what I want to look at here is, should he be pulling more from his RRIF account? And does that benefit him? Drawing more income obviously will create more taxable income, create a bigger tax bill. But is there a strategy here that we can employ to put him in a better position, both short and long term? So here I've made just one simple change, and that is moving that first year from a RRIF withdrawal of just over $15,000, I bumped it up to $20,000. You can see his marginal tax rate is still at 20.06%. I have this client in BC. And so we haven't bumped up his marginal tax rate. His effective or average tax rate is slightly higher, but you can see because we're taking more out of the RRIF, we're not touching as much out of the TFSA. So does this benefit him? Let's take a look. So when we look at the comparison tool, which I absolutely love, we can take any scenarios and compare it, and the data we can compare is just off the charts here. But what I want to look at is retirement spending, which is that $42,000 through his lifetime to age 90, stays the same. We haven't changed that. He's paying a little bit less tax. Perfect. That means that he's paying $400 less tax. His estate is roughly the same at the end of the day. So just by making that one small change, we've been able to save him almost $400 in taxes through his retirement, which obviously, through the next 18 years, it's not a huge number, but it's still $400. Now, you might be saying, yeah, but Adam, if he dies earlier, there's not as big of a benefit. What happens if he died at 80? Well, he is ending up paying a little bit more tax, but guess what? He's got $1,400 more in his estate after tax. So he's collected the same after tax in retirement, and he's got more money when he dies. So even though he's paid a little bit more tax, the net benefit to him and his estate is greater. So that's where a strategy like this says, okay, well, if we make this one little adjustment and it saved him $400 by doing it in 1 year, what happens if we extrapolate that out to more years? Well, let's take a look. So now what I've done is taken that $20,000 and I've inflated it by 2.5% every year. So every year we increase the withdrawal out of the RRIF by 2.5%. So you can see 20,000, the next year 20,500, and so on and so on. So you can see we've depleted the RRIF account by age 90, by life expectancy. The other side benefit is, look at his TFSA account. It actually stays intact right through retirement, creating a lot more flexibility. If he has an emergency, he can draw money from there. If he needs a little bit more 1 year, again, he can pull money tax-free, whereas before, his tax-free savings account was running out. Now let's compare this to the first scenario. So when we run the comparison, you can see here that same amount of income after tax in his pocket. He saved over $6,000 in taxes through his retirement, and his estate is worth $2,500 more. So same amount of money after tax in his pocket, Lifetime taxes have gone down by $6,000, plus he's got more money in his pocket when he passes away. Again, if we grab an earlier age, a much earlier age, let's say 80, same amount of money in his pocket, he's paid more tax, but he has more money after tax in his pocket at death. So he's collected the same while living and has $14,000 more at death. So yes, he's paid more tax, but that's kind of the third piece on the bucket list. I'm worried about money in my pocket. So there's a scenario of someone that's a bit older, required to take the RRIF, single, not a lot of assets, a decent amount, but not a huge estate or anything like that. But these small tweaks, and you might think, Adam, like $6,000 over 18 years, like who cares? But if you're living on a tight budget, every $100 makes a difference. And for this client, he's saving a few $100s every year. That's a big difference. That could be food on the table, another little trip, a getaway, whatever it is. Every little bit helps. Canadians are struggling nowadays to put food on the table, to pay their bills and all of that. So if you can make small, simple adjustments to your retirement plan and essentially put more of your money back in your pocket, even if it's a small amount, doesn't that make sense? Again, this is a 72-year-old single person with life expectancy to 90. So what happens if we looked at, say, a 62-year-old? Well, let's look at that. So here we have a similar situation, but we've backtracked 10 years. So Mr. YouTube is now 62 years old. He has $500,000 in his RRIF account and $100,000 in his tax-free savings account. And so again, taking the minimum amount, supplementing it with his TFSA, we've left the income need the same at $42,000. Now we left his CPP and old age secured at 65. I'm not playing with that in this video. I just want to look at the RRIF amount, the drawdown. Should you be taking more than the minimum RRIF? Obviously, if we looked at CPP and OAS timing, we could make some adjustments there as well. That's for another video. But again, if we did delay the CPP, we'd end up taking even more out of the RRIF account because we're delaying that CPP. We have more years to aggressively draw down the RRIF. Again, that's where these small tweaks can happen. But I just want to show you the difference between taking the minimum RRIF amount, which is a lot of you are doing, versus ramping it up a little bit, being aware of tax situation and all that. Like, it's got to all come together. All your assets and incomes need to come together comprehensively. Whereas a lot of you are just taking the minimum RRIF because you have to take it. It's a really bad play, and let's go through why that's a bad play. So again, we can see here that minimum RRIF amount coming out every single year. And the problem is, by the time that Mr. YouTube is 90, he still has $125,000 sitting in his RRIF account, which creates obviously a bit of a tax bill if he was to pass away then. So much like the last scenario, what I've done here is just for the first 3 years, so before his CPP starts, I've taken $42,000 out of his RRIF. Now you think, well, he only needs $42,000. Correct. We're taking all of his income out and we're letting his TFSA pay the tax bill. You can see $54.33 due in tax, and that same amount coming out of his tax-free savings account. So his only income's coming out of his RRIF. TFSA is paying the tax bill. Super simple. We've kept his marginal tax rate at that 20%. So we're really ramping up the RRIF withdrawals early, meaning that we're paying more tax. And you can see its average tax rate is actually 12%. It's much higher. So does this benefit him? So if we look at the comparison tool, we can see that his lifetime expenses stay the same, $42,000 over his lifetime, but his lifetime personal taxes have decreased. He's paying less tax, $14,000 less tax through his retirement, and his estate's worth more at 90. So same amount of income, less tax, bigger estate. That's the triple threat. Now, if we pull back his death again, let's go to 80 and see what that looks like. You can see there's still a tax savings, $8,700 in tax savings, plus his estate is worth a lot more, almost $12,000 more. So when we look at like, where is it a benefit? Well, yeah, he's collecting the same amount of money after tax. He's paying less tax through his lifetime, and he's leaving more to his estate after tax. That is a huge triple threat benefit. So again, small change, just 3 years of income changes, has a fairly drastic impact on how much cash flow he's producing. So the next level from here is, well, what if we look at that even further out? Instead of just the first 3 years, what if we take more than the minimum RRIF amount for future years as well? So very similar to the last scenario where I've left it at $42,000. Then once his CPP starts, I put it at $24,000 and again, inflated it every year to 2.5%. You can see here as it draws down, the money's emptied out by about 87, 88. So let's call it life expectancy. So he's not running on that RSP or the RRIF amount all the way to age 90, which is a good thing. Now let's see how this compares versus the first scenario. So just by making that small change, pulling more out of your RRIF amount than you need to, going above that minimum, you can see here that, again, Mr. YouTube has the same amount of money in his pocket, but through his retirement, he's paid $15,000 less to CRA. We all love that. But he also has about $15,000 more in his estate, i.e. he's essentially transferred $15,000 from CRA to his kids, charities, people he loves, whoever he's leaving his money to. For the last 18 years as I've done this business, if we put plans together for thousands of Canadians, there's one common theme across every single client that we deal with. They want to pay less tax to CRA. And if you can create a plan where you're putting the same after-tax money in your pocket and you're paying CRA less money and you're leaving more to your estate if that's a wish of yours, that's a win-win-win. And so a scenario like this where we've essentially transferred $15,000 of payments from CRA into your pocket or your estate's pocket, that's a win. Wouldn't we rather give more money to our kids, grandkids, people we love, charity, whoever it is? I think we'd rather give money to any of those versus CRA. And so this very simple strategy, and again, this is like one layer to many layers. Like think of like a multi-layer cake. Figuring out how much to take out of your RRIF is just one layer to that cake. We look at CPP timing. There's many other factors that we look at when building a retirement plan. And that's where a lot of you are just, you're not thinking deep enough. And I get it, it's confusing. There's a lot of moving parts. I talked to someone yesterday, they're like, Adam, I thought I had my retirement dialed in. I realized there's just way too many moving parts. Like retirement is very different than when I was working. There's a lot of options, tax strategy, things like this. Just little simple changes I should be making that are gonna save me a lot of money, put more money back in my pocket, help with the tax bill, all of it. Start correcting course now. Sit down with your financial planner. If you need help with it, reach out to our office. You can learn more about our services. We offer fee-for-service planning. It's a consulting service. We don't sell you anything. We're just taking your information and mapping out the best plan going forward for your retirement. You can learn more at parallelwealth.com/planning. We help Canadians coast to coast. We have offices here in BC, Alberta, Ontario, but we help clients coast to coast. So wherever you're in Canada, we can help you out, reach out, and we'll get you started and get strategies like this built into your retirement plan.